Hello students, in present video I am going to explain about categories of company share capital which are shown in company's balance sheet under liabilities side. Company share capital is divided into 5 categories: authorized capital, issued capital, subscribed capital, called up capital and paid up capital. In present video, let us know about all these 5 points one by one. First one is authorized capital. Authorized capital is also known as nominal capital or registered capital, meaning a company estimates its maximum share capital amount requirement during its lifetime, and it is mentioned in the capital clause of the memorandum of association as the share capital of the company. This capital is known as authorized capital. Thus, it is the maximum limit of share capital that the company can raise by issuing shares. Let us understand the meaning of this sentence with one example. XYZ Limited, a public limited company, is incorporated on 1st March 2024. It is registered on this date. So to run the business, company needs 100 crore rupees, and the company decided to collect 40 crores by taking loans. Short-term loans, medium-term loans, company collects from banks. Long-term loans, company collects from financial institutions. Company may collect loan amount by selling debentures to public, or company may sell bonds to public. And remaining 60 crore, company wants to collect by selling shares. Shares are of two types, equity shares and preference shares. Company wants to issue 4 crore equity shares at the rate of 10 rupees each to public. And company decided to issue 2 crore preference shares at the rate of 10 rupees each. So equity share capital is 4 crore into 10 rupees each, 40 crore rupees. Preference share capital is 2 crore into 10 rupees, 20 crore rupees. 40 plus 20, total 60 crore. Here, this 40 crore rupees is known as debt capital, and the 60 crore capital is called share capital. You know, for incorporation of company has to submit one important document to company's registrar. The document is known as MOA, Memorandum of Association. So this document contains clauses: name clause, situation clause, objective clause, liability clause, capital clause, and association and subscription clause. In capital clause, company has to mention the 60 crore rupees amount, means the capital which company wants to collect by selling shares to public. This share capital is known as authorized capital. So authorized capital means what? The amount which is mentioned in the capital clause of MOA document of the company. And the authorized capital amount includes share capital. It may be equity share or preference share. And remember, authorized capital amount doesn't include the amount which is collected by the company by taking loans. In case of private limited company, the minimum authorized capital amount should be 1 lakh rupees. If it is a public limited company, minimum authorized capital amount is 5 lakh rupees. In MOA document, company mentioned 60 crore as authorized capital, no? So company is allowed to issue only 60 crore worth shares to public, not more than that. So authorized capital amount is the maximum amount limit which company can collect by selling shares to public. So company should not collect more than 60 crore rupees from public by selling shares. That is why when company is fixing this authorized capital amount, safe side, company fixes a little bit higher amount, because in coming future, if company wants to collect some more money by selling shares, then they need not to alter the authorized capital amount. So without changing that limit, company is able to collect some more money by selling shares. Next, alteration of authorized capital amount. For example, company collected 100 crore by taking 40 crore rupees in the form of loans, and for 60 crore, company sold shares in this manner. After some years, company wants extra 10 crore rupees capital. And for this 10 crore rupee, company decided to sell some more debentures to public. So debenture comes under loans. In this case, company need not to alter authorized capital amount because debentures company wants to sell now. Company wants to go for loans now. So we need not to alter the authorized capital amount. Suppose for this extra 10 crore rupees, company wants to sell equity shares, otherwise preference shares or combination of both. In this case, company should not directly issue shares because authorized capital amount is 60 crore and already company has collected 60 crore rupees by selling shares. For this extra 10 crore if shares are issued, then total share capital becomes 60 crore plus extra 10 crore 70 crore no. It is beyond authorized capital amount limit. Authorized capital is only 60 crore. Before issuing extra 10 crore worth of shares, first company should alter this authorized capital amount. And the rules which are prescribed in Company Act is board approval. Company should take board approval by passing a resolution in board of directors meeting. Next, company should take shareholders approval by passing a special resolution in annual general meeting or emergency general meeting. Third one, ROC filing. ROC full form, Register of Companies. So company should submit form SH7 to Register of Companies. And the final rule is company should pay prescribed government fees. So this government fees includes stamp duty and the fees which is paid to Register of Companies. How much fees they have to pay? It depends on the amount of authorized capital. So this is all about first category of capital, authorized capital. Now come to second category of capital. Now second category of capital is issued capital. Issued capital meaning issued capital refers to the nominal value of that part of the authorized capital which has been offered to the public. Thus, issued capital means the share capital amount which is issued by the company to public for subscription. In our previous example, XYZ company is incorporated on 1st March 2024 now, with the authorized capital of 60 crore. In this, company wants to collect 40 crore rupees by selling equity shares. 4 crore equity shares at the rate of 10 rupees each company wants to sell. And 20 crore company wants to collect by selling 2 crore preference shares at the rate of 10 rupees each. Assume that after incorporation, immediately board of directors have decided to collect total 60 crore rupees by selling shares. In this case, issue capital and authorized capital both are same, that is 60 crore rupees. It doesn't mean that company should sell all these shares immediately after its incorporation. Company collects these 60 crore rupees as per its financial requirements. Means in multiple stages, company may collect this money whenever money is required. Board of directors take this decision. When to issue the shares, how many shares are to be issued. Assume that after incorporation, out of the 60 crore, company wants to collect 40 crore rupees. In this 40 crore, 30 crore company wants to collect by issuing 3 crore equity shares at the rate of 10 rupees each and 10 crore by issuing preference shares 1 crore at the rate of 10 rupees each. So company is authorized to issue 40 crore worth equity shares. But after incorporation, company wants to issue only 30 crore equity shares. Similarly, out of this 20 crore preference shares, after incorporation, company wants to collect only 10 crore preference shares amount. Here, issued capital, authorized capital, both are not same now. Authorized capital is 60 crore, but issued capital is 40 crore. In company's balance sheet, authorized capital 60 crore separately we should show and issued capital 40 crore separately we should show. And what about the remaining amount? 60 crore minus 40 crore, 20 crore. This 20 crore capital is called unissued capital. And this 20 crore unissued capital we need not to show in company's balance sheet. In future, when money is needed, then company issues this 20 crore worth of shares. And this issue capital includes 4 types of shares. Equity shares, preference shares, not only these two, bonus shares, even right issue shares also. So this is all about second category of capital, issued capital. Now let us see the third one. Now third type of capital is subscribed capital. Subscribed capital meaning subscribed capital is that part of the issued share capital which is subscribed by the public, that is applied by the public and allotted by the company. Thus, subscribed capital means the capital which is applied by the public and allotted by the company. Regarding subscribed capital, you should know the different scenarios. There may be three types of scenarios here. Means in three ways public may apply for these shares. Full subscription, under subscription, over subscription. Full subscription. Assume that company issued equity shares 3 crore at the rate of 10 rupees each and preference shares 1 crore at the rate of 10 rupees each. So total issued capital is 40 crore rupees. Assume that public applied for all these shares. So they applied for 3 crore equity shares, 1 crore preference shares. So from company side, supply is for 4 crore shares and the public applied for 4 crore shares only. Means demand is also for 4 crore shares. So here demand and supply both are same. Then company satisfies each and every applicant. Means how many shares they are applying, company will allot all those shares to them. In this case, issue capital and subscribed capital both will be the same, 40 crore rupees. This is known as full subscription. Second possibility is under subscription. Assume public applied for 2 crore equity shares and 50 lakh preference shares. Means applications came for only 2 crore 50 lakh shares. But company issued 4 crore shares. So demand is less than supply. In this case, company satisfies each and every applicant because supply is more than demand now. Here, issued capital is 40 crore but subscribed capital is 25 crore only. So subscribed capital is less than issued capital. Then in balance sheet, we have to show subscribed capital, issued capital separately because both are not same. Third possibility, over subscription. Assume public applied for 4 crore equity shares and 2 crore preference shares. So demand is for 6 crore shares. But supply is for only 4 crore shares. So here demand is more than the supply. This is known as over subscription. In this case, companies cannot satisfy each and every applicant. Then directors will take the decision how to allot the shares to them. One possibility, to some applicants, all these 4 crore shares will be allotted. To some applicants, company will reject the allotment. The application money which is received from those applicants is also refunded by the company. Another possibility, to all applicants, company may allot the shares on pro rata basis. Don't think that subscribed capital is 60 crore rupees because company issued only 40 crore worth of shares. No? So up to 40 crore worth of shares only company can allot the shares. Thus, here also issued capital, subscribed capital both will be the same. So issued capital 40 crore, even though applications came for 60 crore worth of shares, company allots only 40 crore worth of shares to applicants. Means subscribed capital is also 40 crore only. Next topic, subscribed capital includes 4 types of shares. First one, the shares which are allotted to public for cash. Second one, the shares which are allotted to promoters, directors and others. For example, sellers of fixed assets, etc. for consideration other than cash. Then the shares which are allotted in the form of bonus shares. Finally, shares which are allotted in the form of right issue. So subscribed capital includes these 4 types of shares. Next, subscribed by whom? Shares are subscribed by whom? In case of private limited company, you know, private limited company should not invite the public to subscribe the shares, no? Then company sells the shares to whom? To company founders, investors, private equity holders. If it is a public limited company, then through IPO or FPO. IPO stands for initial public offer, FPO further public offer. Through IPO or FPO, company issues these shares to public. Means shares are subscribed by public only. So this is all about third category of share capital, subscribed capital. Next one. Fourth category of capital is called up capital. Called up capital meaning called up capital refers to that part of subscribed capital which is asked by the company for payment. Thus, called up capital is the capital which is asked by the company to pay. See, subscribed capital is assume equity shares 3 crore at the rate of 10 rupees each, preference shares 1 crore at the rate of 10 rupees each. So, subscribed capital is 40 crore rupees. One share company wants to sell for 10 rupees, no? Equity share and preference share. This 10 rupees is known as face value of the share, also known as par value of the share or nominal value of the share. Generally, company collects this 10 rupee on installment basis. So first installment amount is known as application money. When investor is applying for shares, he has to pay this application money. Assume in 10 rupee application amount is 3 rupees per share. After receiving the applications, board of directors will decide. So to whom, how many shares company has to allot. And to confirm that allotment, shareholder has to pay second installment money. That is known as allotment money. Say in 10 rupee, allotment amount is 3 rupees. So 3 plus 3, total 6 rupees collected by the company. Then remaining amount, 4 rupee, in the form of calls company collects. First call, second call, third call, and so on. Last call is known as final call. In our example, say first call amount is 2 rupee and the final call amount is 2 rupee. So total 10 rupee. In this manner, company wants to collect. Suppose our current year is 1st April 24 to 31st March 25. In this 2024 and 25 year, assume that company made all these calls. So total 10 rupee company called. Then called up capital is also 40 crore rupees. In this case, subscriber capital, called up capital, both are same, 40 crore rupees. Assume that in current year 24-25, company called only 8 rupees. So application money, allotment money, first call amount. So the final call amount 2 rupee, company is going to call in next year. On both shares, on equity shares, on preference shares, company called only 8 rupees. In this case, in 2024-25 year balance sheet, as a called up capital, how much amount we should show? Equity shares. Public subscribed for 3 crore shares, no? In current year, on equity shares, company called 8 rupees. Preference shares. Public subscribed for 1 crore shares. On 1 crore shares, company called 8 rupee in current year. So, equity share capital 24 crore, preference share capital 8 crore, total called up capital is 32 crore. In 40 crore subscribed capital, in current year, company called up to 32 crore rupees only. Then the remaining amount, 40 crore minus 32 crore, 8 crore is known as uncalled capital. So in balance sheet, as a subscribed capital 40 crore we should show, as a called up capital 32 crore we should show, and we need not to show this 8 crore rupee uncalled capital anywhere in the balance sheet. So this is all about called up capital. Now come to the last point. Now the last category is paid up capital. Paid up capital meaning paid up capital is the amount of called up capital that shareholders have actually paid. It is the real money a company has received from investors after issuing shares. Paid up capital represents real funds available for business use. So paid up capital means the final amount which is paid by the shareholders to the company. So this is the amount which is available for the company to run its business. Assume that company made all these calls in current year. Thus, called up capital is 40 crore rupees. And all shareholders paid all their dues. In this case, paid up capital is also 40 crore rupees. So in balance sheet, as a called up capital and paid up capital, we have to show 40 crore, same amounts. Sometimes, some shareholders may fail to pay some amounts. For example, one shareholder who purchased 10,000 equity shares paid only application money, allotment money. So he didn't pay first call 2 rupee, final call 2 rupee. So from that person on one share, only 6 rupees company received. Then how much will be the paid up capital? Let us see. Up to here you know. So called up capital is 40 crore rupees now, minus calls in arrears. 10,000 equity shares, 2 rupee first call amount, 2 rupee final call amount, total 4 rupee. So on 10,000 shares, 4 rupee per share. So 10,000 shares into 4 rupee, 40,000. Company failed to collect this money from shareholders now. This amount is known as calls in arrears. And the remaining amount is 39 crore 99 lakh 60,000 rupees. So company received only this much amount from the shareholders in current year. This amount is known as paid up capital. So in company's balance sheet, as a called up capital, we have to show 40 crore rupee, and as a paid up capital, we have to show this amount. So here, called up capital, paid up capital, both are not same. While calculating liabilities total, we should not consider first 4 capitals. Paid up capital amount only we should consider to find out the total liability side amount. So this is all about categories of company share capital. So hope this video is helpful to you. Thank you.